I'm Doug MacKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back, everybody.
Hello, Doug. How are you?
Pretty good, John. How about you?
Yep, I'm good. Sun shining today, so as I say, that always makes me a little cheerier.
Yeah, it's beautiful. I don't know where everybody listening is from, but where we are, it's spring. It's, I don't know, mid to high 50s, but sunny, so it feels really warm to us.
Yeah.
And but it was like 27 degrees this morning, so that wasn't great. But yeah,
no, it wasn't. No. But we're finally getting vitamin D again if you get out there a little bit. So
exactly.
Us deprived New Englanders and our vitamin D.
Yeah, going through the cycles again. So yeah, where everyone's back to, oh my God, yeah, it's actually nice out and things are blooming again and things can be alive. This is great.
It really is. I mean, if you just really stop when you're even, like there's a mall, big mall, as you know, right down the street from my house. And, I got stuck at a light and then I looked at this row of these trees. I don't know if there's some sort of magnolia, but they were all the white flowers. And I was just like, yeah, this is a bit of a fairyland, like that. If you just stop a little bit once in a while, you're like, wow, what a beautiful planet. What a beautiful place this really is, right? Because we've seen some drab places on the planet too, but man, when everything's blooming, everything's popping, and it's nice. So hope everybody gets a chance to do that. Yep. So.
Yeah, what are we talking about today, John?
Well, we're going to mention Becoming Your Own Banker, the book. And so hang in there with us, everybody. We're going to try to bore you. We're going to try to simplify something. And, I get to reflect on it. Because I do this, we reflect on the book a lot. And I remember hearing agents, practitioners, that had come before us talk about, geez, I won't even work with anybody unless they read the book, because then, I'm going to refer back to it all the time and I want them to have read it. And I tell them, hey, when they have questions, sometimes I'd say, hey, well, go back and read, this chapter again, because your answer's in that chapter. But it is a little bit like trying to crack the code of what Nelson was saying in each section. I don't think he was trying to simplify things, but in some ways
he speaks in kind of parables, and he's I mean, the info is all there, and it's a book that's worth continually rereading. I mean, I learn new things from it all the time.
Same.
But it's not a extremely simple book, I wouldn't say. It's short, it's a quick read, but I think that it takes a couple times through and is worth kind of talking with people about it, because some things are not quite what they seem if you take them at face value, if that makes sense.
Yeah. Well, there's certain sections of the book that I've skipped and then, end up finding my way back there anyways. It's like it redirects you to go back and, okay, I don't really feel like reading about equipment financing, or I don't feel like reading about somebody's imagination or the grocery store. And that's the one I want to talk about today with you, because it's only, strangely enough, it is only 2 pages.
Mm-hmm.
And I've avoided it, and I don't always talk to people about it. I might bring it up in one of the famous quotes that a lot of practitioners, they like to laugh about it, and say, don't steal the peas, and then that's like an inside thing for practitioners to say that, right? But what he's saying in just these 2 pages is he's really telling the complete story of the infinite banking concept. And he's comparing owning your own banking system through your life insurance policy to being the owner of a grocery store. And I'll try to take one thing at a time. If you want to jump in.
Sure.
What?
I'm along for the ride. I'll hop on if necessary.
You're such a good co-host. Such a good partner. Um, they talk about, and again, we'll use this can of peas. He's saying what he's got to buy it for, and then he's got to uplift it to stay competitive in the market, not overprice it. And there's not a lot of margin, so you've got to roll, through a whole bunch of cans of peas before you actually, you know, make some profit, right? Like, because there's so little margin. And what really he ends up talking about is, well, if you owned a grocery store, and I think, he's kind of going back to pre-liberation days, and he's doing the classic, which is common still, but the guy owns the grocery store, and his wife is probably raising the kids, and she's doing the grocery shopping. But she comes into their grocery store, and she has an option. She can go fill up her basket, and because she is an owner of the grocery store, she can just go out the back door and not even go through the line to pay, right? And there's a lot of selling that has to be done on small margin to make up for what you basically just stole from yourself, right?
Mm-hmm.
You if you were a normal customer, you couldn't just go out the back door. I mean, he went in as far as to say, well, yeah, and of course, if the employees are watching you do that, then they're gonna follow suit, in small ways, maybe at first, in bigger ways if they can get away with it, that they're gonna steal too. But
And I think that that's human nature. What he's pointing out is, and a lot of people do that with their businesses. Families will leech off of businesses and make them eventually unprofitable and unsustainable. But people have a tendency to do things like that if it seems like the easiest option for them.
yeah,
And
yeah,
I don't know. Before reading that, if I guess I would have thought, hey, if your family owns the grocery store, you probably don't pay for things when you go to the grocery store. But
well, okay, so let me back up. Yeah, exactly. Like, and you don't think it seems harmless, right?
it does. It seems innocuous.
Good word. So this really started for me in a recent conversation with a new client who said that when he first started hearing about infinite banking, he was hearing, well, you don't have to pay back your loans. You don't have to, and then he heard, well, no, you should pay back your loans. So that's where we're going. I just want to let the audience know that's where it stems from, and then we're going to lead up into how this whole concept is put into this story. And so
Yeah.
Nelson goes on, Doug, to say, well, if you owned the bank, where would you bank? You you
You'd
bank.
bank at your own bank,
Exactly.
of
And
course.
if you owned a grocery store, where you're gonna buy your groceries. I mean, as long as everything's there and you do have control over what inventory you have. So if it's something you want, you're gonna end up having it in your store. But yeah, you're gonna do the same as you were if you owned the bank. Same way of operating. Your wife or you're gonna shop at your own grocery store. And he referred to the banking customer of your own bank and the grocery store customer of your own grocery store as captive uh, customers. They're not going anywhere else. You know, your wife's going to shop at your grocery store, and well, you better hope so. And why? Well, of course, if you're in the banking business, you're not going to go bank with somebody else's bank. So he said, and this is where it relates to respecting and valuing your own money. He's saying, well, if you're going to buy a can of peas for 57 cents and sell it for 60 cents, but you're not going anywhere else, then you'll pay yourself a little uplift, maybe 62 cents, 63 cents. And that's what he's saying. Okay, he's saying do the same thing when you borrow, right? That you respect your money. And even though you could borrow at 57 cents and pay it back at 60, well, no, pay it back because it goes into your own system, pay it back at 62 or 63 cents
Right.
because you're paying yourself. Your books are going to look better, right?
Yeah,
You're
you're
going to
going to
have
have a
more.
more profitable banking system. That's the whole goal of what we're setting up here.
Exactly. And
And
hopefully it's a it's a it's a family of policies. It's a family of grocery stores, right? Market Basket's the name of the big chain around here, at least for me in my town. And
well, yeah, because you have four of them.
yeah, there's three in my town within 5 minutes. Yeah, and
It's actually really weird. There's two right next to each other, like basically in plazas next to each other, and then there's one across the street, like a quarter mile down the road. It's very strange, and
you
they're all
know
busy.
maybe yeah, they're all pretty busy, especially at the busy times that people,
Yeah,
weekends and nights and that type of thing. But yeah, they're always busy. I mean, they do have everything you need, and the prices are pretty competitive. So, but that is the idea, is you're not going to just have one grocery store. If you're profitable there, well, then you roll your profits, or you, hey, I've got all this extra cash, what am I going to do with it? Hey, I'm pretty good at the grocery store business, maybe I'll put more into that thing. Well, oh, I'm pretty good at the banking business, geez, maybe I'll have another branch of my bank, because if one's good, two's good, maybe three or four, right? And that's what he means by a family of policies. If you have more cash flow, more income, uh, where are you going to put it? Well, you're going to put it in your banking system. So you're going to need either to be able to put more on yourself if you can, or you're going to find the insurable interests in your life, your children, your parents, you know, whoever it is, but you're going to try to put as much as you can into their branches, into their policies. And yeah, and it's more profitable. So, I mean, I probably should take a breath here, but
well, so when he talks, I don't know if people have heard this. It's kind of like a pretty common phrase out there that people will say, "Don't steal the peas." Which, if you haven't read the book, you'd have no clue what anybody's talking about. But that's what John's referring to in this context. Don't steal the peas means don't start this with the intention of taking out a bunch of loans and not paying them back. It's
exactly.
not, it's really nice to know that there is that ability. So down the road, if I were to be in a position where I had no income coming in and I had a bunch of accessible cash value built up in my policy, it is great to know that I could take loans and not pay them back. And I'm not paying income tax on those loans because they're obviously loans, they're not taxable. We've talked about those benefits ad nauseum, on other episodes. So there are a lot of benefits there. But if you go into this with the mindset of, I'm just going to start a policy and I'm going to build it up for a little bit, and then I'm just going to take loans until I essentially there's nothing left to draw from, that's not infinite banking. That's just, it's utilization of a whole life insurance product, which is cool. But the infinite banking part comes from being able to do things when you take those loans that are ideally going to generate cash flow or save you interest that you would have otherwise paid, so that you can then pay back and replenish that system and do it all over again. And when you look at Nelson's life, by the time he passed away, he had some ridiculous amount of policies. I want to say it was like 50 policies in force, right? And the reason he needed so many was because as his life grew and as he was implementing this correctly, his streams of cash coming into him were growing. So his need for banking was continually growing. And he was able to achieve this by being an honest banker, quickly paying back those loans, more quickly than the market interest rate, so that he could then take more loans back out and just rinse and repeat and do it all over again. And by doing that, he created generational wealth through a huge system of policies, like John just mentioned. And that's very different than, going into this with a mentality of, I'm going to have, a policy and I'm going to just fund it for a certain amount of years and then just bleed it dry. And again, there's nothing wrong with that. That's just not really infinite banking. It's not infinite banking.
Right. I mean, if they were the same, you wouldn't constantly have all the available equity in your house borrowed. You wouldn't have it all, taken and used somewhere else and just say, hey, I always want to, just, of course you have payments on that. You don't have the flexibility, because if you don't make those payments, then they're going to take your property. Right. But similar, you wouldn't do that. You don't go buy a house and take a mortgage and start paying it down so that you can just borrow against it all the time and never pay back the loans. You would, it's the same concept. You just wouldn't do that.
Because you'd have an asset that would essentially be worthless after a while.
Yeah. Eventually you'd be like, okay, well, if let's say they let you take 95% of, not most lenders don't, banks don't do that on your home equity.
It's like 70%, I think.
Yeah, but let's say it was 95%. So,
right,
okay,
similar.
You go to sell it, well, you got nothing. And it wasn't that part of the idea, was that you were going to eventually have paid it off and have this asset that then, if you wanted to downsize or you just wanted to move, you had it in the house. But of course, the house is not the same, especially your primary residence, and it's not nearly as good as utilizing the banking system through a whole life policy. But I'm just using that as the
sure,
like, you just wouldn't do that,
right?
And so, yes, back to, we like to talk about the benefits because we try to help people understand that life insurance is something different. Whole life is something different than they've really been made to believe, from what they've heard. So we say, yeah, you can take out, a loan off the value of your policy. Never let that, you never take your own cash, but you get to leverage it. And, you can make your own payments when you want to, and all your own terms. And in fact, if you don't want to pay or you can't pay, you've got all that flexibility too. So we're just showing, some of the benefit. But
it's an amazing benefit. It gives
really
you
is.
freedom and flexibility in the face of adversity, or just it gives you options. But you just don't want to go into this process with the mindset of, oh, this is what I'm going to do with this. That should be not the primary goal and focus.
Yeah.
Would you agree with that?
Yeah. Oh, I totally agree. Like, and back to this, stealing let's just say one can of peas. You have to sell. If you're selling it, you're buying it at 57 cents and you're selling it at 60, you're only making 3 cents a can. And you normally would, again, you're making 60. He says you got to sell 20 cans of peas to make up for the one can of peas that your wife
That you
stole
just took.
out the
Yeah.
back door. And it could be the husband if he's a house husband. So I don't want to pick on wives because
No.
that's not the point. But that just
Well, keep in mind,
one
Nelson was
can.
a much older guy writing this, right?
Yeah, yeah. And just one can is what he's pointing out is it's going to take like 20 weeks or of cans of peas, for you to make up for that, or you got to sell it to somebody else, Yeah, it's crazy. So, but he goes on to talk about, and this is another, for me, another analogy, which is, let's say you were not being an honest grocery store owner and that you were letting your friends and your family and sometimes just take it, go out the back door. um, well, your books don't look as good. You don't have as much revenue, right? You don't have as much profit. And so when people go to sell a business, they show, like, hey, this is what's been happening historically, and this is why we think, we know that you can pay 3 times the book value for this business because in 3 years you're going to get all that money back because this is a moneymaker.
Mm-hmm.
But if you've been diminishing the positive numbers because you've been not being fair to yourself, well, then just compare yourself if two guys were selling grocery stores beside each other. And there was a captive prospect. And they really wanted to expand either their own business or they wanted to get into this business. And they looked at the one who had been paying themselves more. The analogy is that you end up having more money available to you to do all the things, the financing in your life. And when you potentially get to, retirement age, well, how much can you stream out for retirement? Well, obviously, it's all about what you put in. So he was trying to get you to make it as big as possible. Don't be afraid to capitalize your banking system. Don't be afraid because when it comes to retirement, everything you put in, you get to take out tax free. Like, well, then how much money do you want to put in? Well, probably about as much as you can.
Yeah. Well, and I just want to point out too that a lot of people that I know that have been practicing this for, decades, there is no really such thing as retirement for them. I mean, there's a point where they have enough income coming in to more than cover all their life expenses, and there's a lot of stress that gets removed with that. Um, but they have set up so many passive income streams from practicing this that they always have a need to have a place to put their money. Like their banking system is always growing. And that idea of like, saving up and then spending down doesn't even it's not even a thing that they need to do, right? Because that, as opposed to most people that are going to work to a certain point and then stop, they've set up these systems to where it just kind of grows without them even having to do much at a certain point. And that's really what this allows you to do when practiced correctly, because you can leverage this banking system that you've set up, and that is truly the point of infinite banking. And that's the mindset that like I want people to get into, is that we're gonna kind of look at things differently than how most people do things.
Yep. and hopefully we're helping them do that. And hopefully this is a bit of a simplifying, trying to break this thing down, and let's not complicate it. Yes, we do. Congratulations to you and for bringing this idea to me for us to start this podcast, because this is the start of our second year this
Yeah.
week. This we've already done 52, as some people might know, and it's been a lot of fun. But it's really pretty simple, right? It's really, are you a saver? I'm sorry, are you a spender or saver or wealth creator? And this is the means of wealth creation, because you're always using somebody else's money. You always have uninterrupted compounding, right? But you don't have all this other stuff you'd need with a commercial bank. You don't technically have to have a job, whatever that means, right? You don't have to have any particular FICO score, right? You don't have to, follow somebody else's terms and conditions, or else, meaning
Right.
seizure, right? That they're going to
Yeah.
take it from you. You don't, but commercial banks don't give you life insurance. You've got loss exposure to, if you have an outstanding loan, let's say of $100,000, or I'll do it on me. I have an outstanding loan on my house for $100,000, and I die. That debt is still due. It's got to come from somewhere. But if I took the loan from the bank, I don't have anything. But if I took the loan from my policy, they just take the loan balance off of the death benefit. Yes, my heirs, my children, whatever, they get less death benefit, but they're not stuck with the debts that I created, right? So
Correct.
there's absolutely no comparison. Or if you try to compare it, you go, it makes no sense to do, or if we have this option with whole life and the infinite banking concept, that I would go to a commercial bank for my funding if I have access to enough capital. And how do I do that? Well, I have to take action, and I just have to be consistent about it, because I'm going to need financing in my life one way or the other. Most people do.
Mm-hmm.
And where are you going to do that funding? Where's that who's the lender, and who's gonna be able to do it? Those that have taken action ahead of time, not when there's no other option, like the world's falling apart and I don't have a job, and well, have the cash flow then to start building a banking system. So there's no time like the time you can do it. Do it now if you can, because like Nelson, he said it took him 14 years to get out from under. But again, as we've said in other podcasts, that months before he passed, in the movie This Is Nelson Nash, he said, my grandchildren, great grandchildren will never have to work with a commercial bank. He
Mm.
literally said they'll never see the inside of a bank, but he
Yeah.
meant that they'll never have to work and go lend, borrow money from these people that then
Yeah. They
potentially,
make money off you.
yeah, they eventually may come and take what it is, because you put something up. Well, you in whole life you put up some premiums that you can utilize, but you put up your life, what you're capable of producing, what your life is worth in money terms.
Mm.
And so if you do pass away, well then, yeah, they'll, you've got that, you've got that coverage. So,
Love it.
yeah, okay. So that's a wrap.
That's a wrap.
All right, my friend. Yeah, I once again I always enjoy this. So
Same.
yeah, please let us know, everybody, if we can
Yeah, if you
help
have
in any
anything you'd
way.
like us to talk about or any feedback, please share. We'd love to hear it. And until next week.
Yeah, I look forward to that too. All
Okay.
right, enjoy your
All right.
week.
You too,
Thanks,
Doug.
Doug.
Bye.
Bye. Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.